Today, we're not just looking at numbers on a screen, we are cracking a code. We're about to break into the vault of conventional wisdom to pull off a data heist and expose the great myth of living off dividends.
All right, let's get right to it. The one question every single person asks when they start dreaming about financial freedom is this: how much money do I actually need to live entirely off of dividend checks?
For one of the most common strategies out there, the answer is 5 million euros. Yeah, you heard that right. You'd need a cool 5 million just to generate 50,000 euros a year in income. It sounds insane, doesn't it? Well, today we're going to show you exactly why that number is so ridiculously high.
The truth is, the way most people think about dividend investing is just fundamentally flawed. So in this explainer, we are going to expose all those hidden flaws and give you the blueprint for a much smarter and way more efficient alternative. Okay, so every good heist needs a target, right? A mark. And in the world of dividend investing, that mark is yield. Let's take a look at 3 common heist plans that investors use to try and capture it, starting with the one everyone knows. So strategy number 1 is the classic move. You just buy the whole market. You get a broad market ETF, something that tracks the S&P 500. It's safe, it's diversified, it's the bedrock of the US economy. Can't go wrong, right?
Well, here's where it gets really interesting. When you break it down, while the total growth is pretty great, the actual dividend yield you're getting is tiny, like around 1%. And that's the math that gets us to that 5 million euro number. Almost all the profit is coming from the stock price going up, not from the cash they're paying out.
So you can see the problem, right? A 1% yield just isn't going to cut it for anyone. So what happens? Investors get restless. They abandon the safe, broad market, and they start to hunt. They go chasing stocks that are known for one thing: paying out higher dividends.
This brings us to plan number 2, targeting the so-called dividend aristocrats. These are the companies that have a super long history of raising their dividends. The yield is better, sure, about 2%, and that cuts the capital you need in half, down to 2.5 million euros. It's an improvement, but let's be real. It's still a crazy inefficient way to generate income. And so the chase goes on, all the way to its logical extreme, strategy 3. This is where you forget everything else and just grab the ETFs with the absolute highest possible dividend yield you can find. Now we're talking. With yields close to 9%, the capital you need drops to just over 500,000. It looks like you've hit the jackpot. But, every good heist has a twist, and there is a massive catch. And here it is. This is the trap. Yeah, the dividend yield is sky high, but the total return, not so much. Why? Because a super high yield is often a massive red flag that the stock's price is actually falling. You're getting cash in your hand, sure, but the value of your main investment, the thing you actually own, is shrinking. So you see, this whole vault that we're trying to crack is booby-trapped. This obsessive chase for dividends leads people right into these hidden financial traps that can completely sabotage their wealth in the long run. And here are the 7 big ones we're about to disarm. We're talking about everything from poor diversification, which we just saw, to losing control of your own income, to tax problems, and even to companies and funds that are actively manipulating the system because they know how much people love dividends. Just think about this for a second. Who should be in charge of your personal paycheck? You, or a group of executives you've never met sitting in a boardroom somewhere? Because when you rely only on dividends, you are outsourcing your personal budget to them. They decide how much you get, and they decide when. You've given up all the control. And here's another thing. Focusing only on dividends is, it's an outdated strategy. A lot of the biggest and most successful companies in the world today prefer to reward their shareholders with something called a share buyback. It's just a more tax-efficient way to return cash, but it doesn't show up in that juicy dividend yield that everyone's chasing. All right, so we've seen the traps, we know where the lasers and pressure plates are. Now it's time for the clean getaway. Let's talk about the smarter, more elegant way to get the prize. And that prize isn't just income, it's total financial clarity and control. First things first, we have to absolutely demolish the most dangerous illusion in all of passive investing. It's this belief, this myth, that if you only spend the dividend checks, you're living off the interest and leaving your core capital untouched. That is 100% false. Let me explain. The second a company pays you a dividend, that cash leaves their bank account. So the total value of the company drops by that exact amount, which means the stock price drops too. A dividend isn't magic money from a tree, it's literally just a piece of your own capital being moved from their pocket to your pocket. It is functionally the exact same thing as selling a tiny piece of your stock.
And once you really truly get that, the choice becomes incredibly clear. Do you want some corporate board deciding when and how much of your investment to sell for you? Or do you want to be the one in control? This elegant alternative is all about taking back control of your own income.
And here's the getaway plan. It's beautifully simple. Step 1, invest in broad, low-cost funds that automatically reinvest any dividends they get. They're often called accumulating ETFs. This just maximizes your growth. Step 2, you create your own dividend. You decide how much cash you need, and you just sell that amount of shares whenever you need it. You pay yourself.
This approach is just superior. I mean, you're in the driver's seat. You have total control and flexibility over your income. In most countries in the EU, it's way more tax efficient. It keeps your portfolio diversified. And maybe most importantly, it forces you to focus on the only number that really matters: the total return, the total growth of your wealth. So when you strip it all down, busting the dividend myth forces us all to ask one final, crucial question about our own financial plan. Is your strategy just built to capture little streams of income, or is it engineered for the much bigger prize, building real, lasting wealth? The choice is yours.